With the Federal Reserve looking to cut interest rates in 2024, now might be the time to lock in some of your cash in a high-yield savings account, CDs, and money market funds that pay anywhere between 4 and 5% in interest at the time I'm recording this video. Now, I want to make it clear that you need to have a purpose for saving in a CD, HYSA, or the money market fund. You don't want to put all of your eggs in the same basket because the risk of doing so could lead you to the loss of higher gains in the stock market. The stock market historically has made more returns than these accounts I'm going to go over. So be sure to do your own net worth statement so that you have a clear balance between how much you invest in the stock market and how much cash you have set aside.
That's the best bit. That's the best bit.
Here's the reason why you might want to start shopping for high interest products like CDs and money market funds. Many economists and Wall Street investors are predicting that the Fed will start cutting interest rates as early as March 20th, 2024. I personally think this is too soon, but the market is only predicting that the Fed will cut interest rates by 25 basis points, which is a fancy word for 0.25%. So let's say they're right and they decide to cut interest rates by 25 basis points. The high yield savings account I have is currently sitting at 4.5%. So that will most likely be cut to 4.25 or maybe even 4.15%. And there are many other factors that go into the rate cuts, but I'm gonna keep this explanation as simple as possible. But take a look at May 1st, 2024, because I think this is more of a realistic scenario. The market is predicting that there's a higher chance of cutting interest rates by either 25 or 50 basis points. If they start cutting interest rates by 50 basis points, then I could see my savings accounts APY dropping to about 4%. Is 4% still high? I would argue so, but it depends on what I'm trying to do with the money, right? This can also affect money market funds and CDs because they're dependent on market interest rates. And by the end of 2024, there's a chance that the Fed could cut interest rates by as much as 125 basis points or 1.25%. And I wouldn't be surprised if investors decided to pour more money into the stock market at that point. And I'm already seeing a lot of rotation out of the cash reserve back into the stock market. And according to Yahoo Finance, there is a record $6 trillion in cash in a money market fund that will help the stock market in 2024. And as soon as the Fed starts cutting interest rates, take a look at this. Money market funds like this one are going to start cutting rates. And I'm just going to use Fidelity Government Cash Reserves, ticker symbol FDRXX, as an example. And this is not in any form of financial advice. You should do your own research before deciding to invest in one. And you can always schedule a free 20-minute session with me by visiting firesuchet.com/coaching to find out if I'm the right fit for your financial journey. This money market fund alone has about $233 billion in net assets as of a month ago. In 1 year, it's made a 4.89% in net return. And you have to keep in mind that even if it says 5%, you're not really getting that 5% return. Every money market fund has an expense ratio you'll have to pay the fund manager. So when you pick and choose a money market fund, you need to keep the expenses ratio in mind. And it's always good to know what's inside a money market fund. And most of them are about the same. This one has 48% in US government repurchase agreements and 25% in US Treasury bills. And if you're brand new to investing, Treasury securities or government securities are considered a safe and secure investment option. And that's why many investors have some bonds or bond-like investments in their portfolio so that if the stocks go through a tough time like they did in 2022, you have some Treasury securities to back you up. So while the money market fund is technically an investment vehicle, you can't typically invest in a money market fund with an online brokerage account like a taxable brokerage account or a Roth IRA. But if you're looking to lock in a rate for a certain period of time, a CD might make sense to guarantee a rate of return. Now, I hate the word guarantee because it's a word that nobody in the financial sector likes to say, but in this case, the CD rates will also go down when the Fed starts cutting interest rates unless you lock into that rate prior to it. So what you can do now is to lock in to the rates before they cut them because you'll still earn the amount of interest that you were receiving before the drop. High yield savings accounts and money market funds don't offer the same deal. Now, I never recommend putting your emergency fund into a CD. You need to make sure that you have access to that emergency fund 24/7. you should leave that in a high yield savings account. But if you have more than 6 months of expenses in your emergency fund because you're getting ready to retire or you're already retired, then you can use the CD to make the money work for you. If you're also looking to buy a house, a rental property, or make a big purchase in the next year or so, putting this money in a CD might be a safer option than putting it in the stock market. If you're looking to save $10,000 to purchase a vehicle in the next 18 months, then using a 12-month CD might make sense in this situation, right? The bottom line is that you need to have a clear purpose before locking your money away for the next 6, 12, or 18 months. The purpose of a CD is not to build wealth. It is to beat inflation so that you have more purchasing power for whatever it is that you're going to do in the next 12 to 24 months. Now, most people choose to save in a short-term CD that's typically less than 12 months. And if you go over 12 months, they pay you at a lower rate because the banks don't want to risk paying you too much interest if the Fed cuts interest rates. Remember that the banks are paying you interest from the interest they charge from other people's personal loans, credit cards, and mortgages. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. So if you're looking to lock into some of these rates right now, people use the CD ladder strategy to make the money work for them. And let me briefly explain to you how this works. A CD ladder is essentially using multiple CDs to maximize your interest earning potential. And what I want to do is limit myself to $250,000, which is right under the FDIC insurance limit. And you want to make sure that the bank is insured by the FDIC. And I also want to make sure that I have enough liquid cash in a high yield savings account so that I don't have all of my cash tied up in multiple CDs. There are CD terms that you can find with almost any online bank, but you want to make sure that it's got good reviews and decent customer service. And I'm not going to mention any specific banks because I don't want you to think that I'm sponsored by any of them because, well, I'm not. Let's say you have $30,000 in cash and want to start a CD ladder. In this example, you can find a 6-month CD term for 5.25%, a 9-month CD term for 5%, and a 12-month CD for 4.75%. The Fed funds rates are 5.25 to 5.5% at the time I'm recording this video. So the rates might be different depending on when you're watching this video. But let's just assume that I'm going to put 10K here and 10K in here and another 10K in each of these CDs. So when the first CD matures at 6 months, I can either cash out or continue to build my ladder by investing the funds into a 9-month CD. When the 9-month CD matures, I can put that money into the 12-month CD. You don't have to exactly put $10,000 into each CD. You can put a different amount in each CD if you want to. It's completely up to you. You also don't want to have too many CDs because if you lose track of the maturity dates between these CDs, you're going to lose the very short time window to either withdraw the money or move it to another CD. I always recommend that you create a spreadsheet to keep track of your CD maturity dates and earnings. And you can download my financial resources for absolutely free by visiting firesightchat.com/resources. So if you start your 6-month CD savings on February 1st, then the maturity date is on July 30th. So you got to remember, it's not by 6 months, you got to count them by 180 days. Your bank should tell you the date your CD matures and the time window to either take money out or leave the money in there. You have to keep in mind that the bank might tell you 5.25% APY, but you have to divide the interest in half because it's only for 6 months. So if I earn 5.25% in the APY for $10,000 in 6 months, that's not going to be $525. It's actually going to be $262.50, give or take. A lot of people get this wrong and thinking that they're going to earn the whole 5.25%, but they forget that they're doing a 6-month CD. The 5.25% is the APY, which stands for annual percentage yield. And it's almost like a trick question that a math teacher would put on your pop quiz. So after the CD matures in 6 months, there's a good chance that the Fed has already decided to cut interest rates during the June FOMC meeting. So when you renew this CD in August, let's say, your 6-month CD could drop from 5.25 to, let's say, 5% at this point. And depending on how much the Fed cuts interest rates. Is that a big deal if you have $10,000? Probably not for 25 basis points. However, if you have a jumbo CD in hundreds of thousands of dollars, then you might need to reconsider the opportunity cost in the market instead of keeping your cash in the CD, right? You also have to consider how much cash you have in your money market fund and high yield savings account when the Fed starts cutting interest rates. This strategy to keep cash in a CD or other high yield products should only be used to earn more interest than inflation so that you can maintain your purchasing power. And I never use CDs, HYSA, or money market funds to grow my wealth. The vast majority of my investments have been in the stock market. However, I am looking to purchase real estate in the future, which will require hundreds of thousands of dollars in cash for the down payment. If you're looking to purchase a vehicle within the next 2 years, keeping cash in one of these high yield accounts might make more sense so that you don't put too much risk exposure to the cash savings you're looking to spend. In 2021, when the stock market was at an all-time high and when the inflation reports start coming out red hot, I chose to put more cash on the sideline because I kind of suspected that 2022 was going to be a rough year. But either way, I always have cash on the sideline ready to deploy to the stock market and buy assets. I always go live when the latest inflation report comes out. So be sure to subscribe if you haven't done that already. And this has been another beast of a video, and I hope you got a lot out of it.